What's up, folks? I hope you're all having another blessed Wednesday. We are back with a midweek banger because, as you know, I didn't make a weekend banger. I had to spend some time with my little man. It was his birthday, and shout out to all the people, and thanks so much for wishing my son a happy birthday. I showed him all the comments, and he was flabbergasted. I was like, how are who are all these people? But he was super happy to see that. So, again, thank you so much for wishing him a merry happy birthday. Now, I've had actually a lot of stuff I was going to share on the weekend, but I didn't. So now I have all this stuff I have to share and get off today in the midweek banger. And the big question is this in fact the blow-off top that we've all been waiting for before it's all over? And that is basically what we're going to talk about today, along with oil in the second half of the episode. So let's get at it because we've got a lot to talk about. So is this the blow-off top? Now, we've got the GOAT here, and you know who the GOAT is. It's our dear friend Warren Buffett, and he is the GOAT. Make no mistake, he's the only one in the top 10 richest people in the planet list who is an investor. Everybody else is in tech or some other kind of commercial product like LVMH or something. He is the only investor in the richest, so he is the GOAT. Until somebody bumps him off that list, there's no question about that. Now, what did he say back in the dot-com bubble in 1999? His famous words were that euphoria is the enemy. And then he recently came out and said in his last interview that we've never had people in a more gambling mood than now. Now, this is a nice chart put together by Merlin, minus a little typo over there. There's many versions of this chart, but I like this one because of the coloring. So shout out to you, Merlin, for putting this together. But the point here is, what are we looking at even? This is from the thumbnail. Well, what we're looking at is the S&P, right, over the money supply. And that ratio we are at basically back when we were at with the Y2K dot-com bubble. If you look at what happened in 07, 08, it didn't go out that high, right? That whole crash didn't, it wasn't as euphoric, I would say, as the last time, which was in the dot-com. So we are at that level. That means the amount of money and the value in S&P 500 as a ratio to the overall money supply, which incorporates all the money that's printed. So that ratio of printed money to the value of the S&P 500, we are there. And so the question is it up and away to never, ludicrous mode like in a Tesla? Or are we gonna correct here? And that is the question we're gonna try and answer today. Now, before I continue, I just wanted to say, shout out to my wife with the merch. She came back from the States and had a bunch of t-shirts, and, I saw this one and I was like, bro, you've been watching my videos or what's going on here, man? Because this is my anti-Axios t-shirt, right? So Axios, here's looking at you. Now, what I want to bring up is that there are many points of view to this. So there are some people who claim that there's no way we can be in a bubble because everybody's talking about us being in a bubble. And I just want to nix that right off the bat. First thing I want to do is just nix that. Because guess what? Back in 1999, right before the bubble popped and the dot-com bust, in the Wall Street Journal, okay, front page, if this is a bubble, it sure is hard to... People were talking about bubbles back then. It was the main item, okay? The front page, top half of the newspaper was bubble talk about basically the stock market right before it popped. So you can't tell me when you look at, front page of the major Wall Street Journal newspaper saying that this is a bubble, that, just because people are talking about bubbles now, we can't be in a bubble. Like, let's just put that to bed. That is absolutely inaccurate. We shouldn't be talking about that. That doesn't happen. It's a myth. Drop that and move on. So moving on, what are we talking about then? Well, there's some people who say, well, people love to overlay stuff. I told you, people love to do this stuff. And they say, well, if you look at it, we're here, which means we are going to go up here, which means what is this? Like, are we gonna triple from where we are now? That would be like, S&P 20,000. But that is a case that some people are making, right? They like to overlay, and then we say here, like, there's a lot of money to reallocate, although there's some data that I don't know about that. I'll show you in a bit, but that's what some people think Other people are similarly saying, look, hey, look, as far as the distance from exponential growth, so this is one technical analysis metric. They pick that one thing out and they say, let's pull that out and look at it. Well, you know, like from back then in the 2000s, we were right here, you know, as far as from the exponential growth trend line that we're this 100, about 50% above the exponential growth trend line. So, you know, we're nowhere near .com. So we still have this to go, which, I mean, if you look at this, it's like 1, 2, 3, 4, 5. So like then S&P 500 would be like, I don't know, 35,000 S&P 500 if we were to get up here. So my point here is there's multiple ways to look at this whether or not this is .com all over again. And I just want to be clear, I'm not shorting the market. As I've said many, many times, I'm watching this because I do think we're closer to the end than the beginning of this secular bull cycle, but I'm not actively shorting the market. That means I'm not losing money doing this. And as people who have been following me here online, on X, or on the Discord know, I've basically been trading long oil and also some long silver as a tester, which I'll talk about at the end of this video. So while I'm not short, I'm watching this because this is basically general markets, you know, dynamics for the equities. Now, let me tell you what I am looking at that makes more sense to me. First of all, is there's no denying that the money supply has in fact increased, and this bump up here that we recently saw the past few years, especially with this little bump up here, well, that could be the reason why the stock markets were going up, you know, mechanical reasons for the market to go up, the CTAs, the short covering, and all that on low volume, which, again, as I said, low volume doesn't necessarily mean the rally is fugazi. It could be a continuation of the rally if volume comes in and people are forced to buy. So we can't just make that generalization that they're, you know, no volume, so, you know, it's a fake rally. No, you can't do that. It could be or it could not be. You can't just use that as a singular thing to determine it. But make no mistake, big volume in terms of money supply expansion usually leads to stock price expansion as well. So that's one thing, that's a fact. Now, one thing I also want to look at when it comes to past melt-ups is the actual cumulative total returns. So in the 1920s, the roaring 20s, it was around 490%. In the 50s, remember that one? We had about 490%. Japan had a 510%. Remember the Japan bubble? That was really bad. NASDAQ had an 800%. And NASDAQ over the past 10 years is at 640%. So, I mean, the bottom line here is we are at pretty much stratospheric levels in terms of cumulative net returns. So we're up there already. We are up there in the clouds. The other thing that I look at that matters a lot to me is the concentration. Okay, so how concentrated is the market? And every time the market gets too concentrated into one sector that everybody believes is the messiah, and it's going to just change the world, change everything we know about economics, change gravity, change the universal law of physics and economics, basically just change everything that we know of. It never did, because everything still works the way we thought it did. That's when we tend to have bubbles pop. Now, we're at 40% and it's still rising. So could it rise somewhere? It could. But back then, we had multiple reasons of why it popped, right? .com. This was Japan. Very concentrated into Japan's tech sector. Remember Sony? Okay. Then back here, right? The Nifty 50, if you're old enough to remember that one. It was in tech and telecom. Now, the biggest one ever recorded was during, actually, the 1800s, when the railroad situation, basically everybody went into railroads, more than half. And that was a huge, huge bubble that one ended up popping as well. So point here is basically whenever it hit 40, meaning the entire market's concentrated and betting its life and entire existence into one sector, usually tends to be tech. We also had, actually in the 20s, you don't see it here because but in the 20s there was also into tech. And the tech back in the 20s was stuff like the telegraph, like there was tech back then as well, and it was concentrated, even though it's not shown in this chart. So, just keep that in mind. So we are there again in terms of concentration, right? I just want to point out with the railroads at 63% in 1881, that was crazy. It more than half, 63% of was made up of railroads. I mean, the entire country was, and for good reason back then, right? But for good reason. And none of these didn't change the world. Railroads changed the world. The internet changed the world. AI will change the world, but that's not what we're talking about here. We're talking about the valuations of the stock market because of that. And we are up here. So can we go up here? I mean, it is technically possible, but in recent modern history, okay, not in 1800s where it was a very different kind of stock market in terms of liquidity, in terms of valuation, in terms of people involved, that was just a different world back in the 1800s. Okay, in modern history, like past 100 years, whenever we hit 40% of concentration, that's when things tend to stop. And as far as cash sitting on the sidelines, a lot of it is very high. Look at this. Going back 20 years, private equity this is private clients and BFA. They're into equities already as percentage of assets under management, 65%. That means they're all in, right? They have to have some cash reserves and some into bonds and whatnot, but they're very allocated into the stock market already. And the same, if you look at it from this way, it's the same thing, right? Cash allocation is at record lows in 20 years. So that tells me that it's not like nobody's in the stock market. There's a lot of money waiting on the sidelines to pump in. In fact, it tells me that a lot of money is already in. And to actually put in even more money would be literally crazy, right? That means that that's just betting not just the farm onto the stock market, which means you're basically, because the stock market is basically AI, you're betting your farm, your children and grandchildren's lives into AI, right? Because the stock market is AI basically. And so there's not much more room if you look at it. And then if you look at it from the point of view of breadth, I mean, again, we're at record low. Breadth meaning is who's leading the charge. And it's just a very concentrated group of companies, basically AI related, that is leading the charge. And that is the breadth is at record lows here, guys. So, we haven't been this low in years. And before that, in many decades. That's how low the breadth is. Then you look at the concentration. And so as far as concentration goes, we're at record highs. Record highs. The number of constituents. So as the number goes lower, that means less and less companies are controlling the S&P price. And we are here. Look, 30 years, 3 decades, nowhere near where we are today. We are super loaded up into AI. And then if you look at, well, what is contributing to the overall index growth? It's how many companies? And then the rest of the index. So if it's 12 and over 6, so it's like half is by 1, 2, 3, 4, 5 companies contributing to the growth of this S&P. How much more concentrated can it get? Will we get to like one company is the S&P 500? I mean, if you got 5 contributing to more than 50% of S&P 500 growth, are we going to get to the point where there's like one company? I mean, take your pick, right? If Anthropic goes public, will it be Anthropic? That's the S&P, so it's the S&P 1, right? It's not S&P 500. Forget the S&P 500. You just call it the S&P 1. I mean, are we going to get that? Because that's where we're heading. That's where we're heading. And you don't want to be in that situation. You really don't want to be in that situation. Now, everybody's been piling in. I told you, like, the money is piled in. And if you look at... Now, this is notional, okay? This is notional. The total notional value of calls, the volume, has reached 2.6 trillion. This is crazy. This is crazy. So what does that mean? That means there's so many people going along the stock market, whichever way you want to do it, through options or whatever strategies you want to, but basically call volume is at $2.6 trillion notional, levered up or put it all together. And you know, going long here is probably not a good idea. I don't know, man. I'm not Einstein. I'm just a schmeck on the internet. But you know, going all in long here is probably, I would say, maybe not the best thing you can do in your entire life or the best time in the world to go long the stock. I don't know. That's just me. Maybe I'm wrong here. So it's not only the call buying, but look at the put to call ratio. So look, this is an interesting chart because look what happened here. Everybody was, so this is a put to call ratio. So it's when it's high, that means puts are high, means everyone's shorting the market, betting the market's going to go down. Now, it was very high, right around at the bottom. So everybody was thinking, including me, make no mistake, right? The whole Wyckoff thing did not pan out. Now, I didn't go short the market because I thought there was going to be a bounce, thank God. And then that bounce turned into this massive monster rally. So while I didn't lose money, I did miss out on making that, but it's not like I didn't make any money because I was also long oil and you saw what oil's been doing. So anyway, the point here is everybody was shorting the market down here. And now that it's exploded up, the ratio's gone down. Now there's not that many shorts. The shorts are going away, which is actually what you want to see if you want to think that this rally can't go vertical forever. If there's no more shorts, that's usually around the time when things can make a turn. And that's what we're seeing here. So the put call ratio has gone down. Not everybody and their mother is shorting the market anymore. In fact, as I showed you in the other one, everyone's going long. So at one side, so imagine a boat, okay? And you're in a boat. So at one point, everybody was on the left side of the boat. Okay, that was when we were down here. Then now everybody's on the right side of the boat. And the boat is so fully loaded on the right side, it's about to like tip over into the water. Everybody's on one side of the boat right now. When that happens, it's usually a sign that not a good time to join in on that side of the boat because everybody's there. Probably should look at the other direction. The other thing going on is this huge divergence again. I'm talking about breadth, but look at the S&P 500 and look at the new 52-week high and low. So yearly, how many highs versus low? Very few compared to, so many companies are making new yearly lows in their stocks. Right, this is going down, whereas this divergence is also not a good sign in terms of what is going on. Then you have, if you look at the corporate high yield bonds advanced decline line, that is also showing you. This is from McClellan, who is the guy who created the McClellan oscillator, and he's saying that this it doesn't. So he's being objective here. He's saying like these divergences can be rehabilitated. So he shows you when they didn't work out. So it's not 100% guaranteed, is what he's saying. However, look at this, the level of divergence here. This valley is huge compared to these smaller ones, much like the valleys here, which did work out. And so what he's saying is you got to be careful. I agree with this. You got the corporate yield high bonds AD line going this way. This is a big divergence from what's going on with the equities market. Then finally, I'll show you there's a measure here for global financial time. So basically, they use this indicator. This is a forward-looking indicator for about 6 months to push forward basically the velocity or tightness of money. And it has been going down. So usually, as the leading indicator, it would signal that money tightness will in fact follow. And if that does occur after they've push forward for 6 months, you would think that then the money supply velocity and supply would go down, which would mean downward pressure for the market. So for those reasons, you can see like there's a lot of technical, when you look in the internals, of unhealthiness in the stock market, despite the high rise in prices, driven by what so far has been very good corporate earnings. And a lot of people say, well, look, this is the K-shaped economy. So K-shaped economy meaning, the earnings will continue to do well in these certain types of companies, whereas these other types of legacy companies and people in different, lower I guess income classes will continue to suffer. And so you have this dichotomy of an economy, hence the K-shape. And so this will continue, but that means stocks will continue to go up. So that is a perspective and narrative that has logical sense. I get it. And I agree that that is definitely one of, if not the main reasons why, from a fundamental reason, at least, people can marry that to why stock prices are going up. However, again, when I look into the in-market you peek behind the curtain and look at what the market internals are telling you, it's malaise. It's not good except for this super concentrated sector. But that in and of itself is a huge risk, because every time we've gotten this super concentrated and prayed to the messiah of whatever that thing is, and that it's going to change, quantum physics as we know it, and everything before, doesn't apply, that's when you have this time is different type of mentality start to think in, and then you say that over and over for all these different things. That's usually when trouble begins to happen. And that's where I believe we are now. One of the things people also look at is the Home Depot stock price, because Home Depot, let's face it, it's a derivative of the real economy, right? People buying actual stuff, doing homework projects, and so on and so forth. And the last time it had a divergence back in 07, 08, basically was saying generally the narrative, the real economy is not doing well, even as stocks were going up, right? And then stocks caught up and went down. Well, we're in the same situation here. Home Depot is not doing well, stocks doing up. And this has been going on for years, right? So it took years as well here. And so that is another thing that's not a good sign. How long can this gap continue? Well, we shall find out. And, when I look at, okay, so I got to tell you that these time frames that I'm discussing here, they're not daily, weekly, or monthly, or even yearly. If you look at the timescales of all the charts I've shown you, it's in decades, many years. So, this came out in Discord one day. It's like, yeah, it's gonna look. If you're trying to time the market on a cycle that takes decades, you're asking for pain. Unless, that's just really hard to do, because, a blip on that chart is like months. And what are you going to eat losses for 4 or 5, even 1 or, 1 year? I mean, that's tough to do. No matter how mentally strong and disciplined you say you are, it's not easy. That's why there's only like one Warren Buffett. But that doesn't mean, again, that you can't prepare at all, which is exactly what I'm doing. And so while I have a long-term fundamental point of view, I don't trade that. In fact, I use the technicals of what's going on to make shorter-term decisions on picking an instrument of what to trade and then trading that instrument as I have this longer-term fundamental picture forming in my mind. And that is how I operate. So I just want to point that out, right? I'm not telling you the top is in tomorrow, it could be in tomorrow, but that's not the point here. There's no way to kind of time the market in these like multi-decade long cycles. No way, man. But that doesn't mean we can't talk about it, because it is the underlying thesis of what is happening and what I'm trying to prepare for, even as I take trades more on a technical reason and more of a short-term time frame. So, heading back, what do I look at in the shorter terms? Well, one of them is where the hot money is. Now, the hot money is in, this is the Korean stock market, right? The equivalent to S&P 500 in Korea, the KOSPI. This is like a meme stock, but this is the entire stock market, the KOSPI of Korea. To me, this is hot money. Degenerate Korean investors, or gamblers, should I say. And I'm Korean, so I know my homies over there, they're degenerate gamblers. They taking this thing up like crazy, right? This is literally vertical. And I've always said vertical up means vertical down at some point, just nobody knows when that top is, and nobody knows, right? There's nobody rings the bell, okay, at the top. There's no ding, 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 ding at the top, and everybody gets up. And this is something I just want to reiterate. I also shared this on Discord. The idea is that everybody thinks they're going to be smarter and faster than everybody else. They're going to be faster and smarter than everybody else to get out at the top. Right? That's in every single person's head who's playing it. And that's why they play it, because they think they're going to be able to get out before everybody else. Otherwise, obviously, they wouldn't be playing it. But mathematically, that's impossible. If everybody can get out before everybody else, that's impossible, mathematically speaking, right? There has to be the first one who gets out and the second one, the third one, and all the rest weren't the first one to get out. So mathematically, like simple arithmetics, you can't do that, right? There is a first one to get out, the second, the third. And so, but this mental cognitive dissonance of everybody thinking the same thing that is mathematically impossible is why people play the game of musical chairs, because they think they can outdo everybody else, and everybody thinks the same thing, which is impossible. That's why the game keeps playing. But make no mistake, nobody's ringing the bell at the top. You don't know, but you believe you're faster and smarter than everybody else, and you're going to get out and not get toasted, and that is the belief that leads to many people losing their shorts. Because when there is a crash and it goes down just as fast as it went up, obviously there are people losing, right? That's when you have vertical down, there are many people lost along the way down. So just keep that in mind, right? So to people who believe they can time the top, you might get lucky, but then you'll be that one lucky one out of 100 or 1,000 or 10,000, right? Everybody else didn't get lucky. That's just math. Now, I look at the KOSPI because the KOSPI to me is the hot money. This used to be represented by Bitcoin, okay? I used to look at Bitcoin as, a leading indicator because that's where the hot gambler money is. And so if that hot money goes out and this goes down, that means that's coming to less hot money markets like the S&P 500s, for example. And it used to be Bitcoin, then NASDAQ, then the S&P 500, then, all the other sectors in the S&P. But I would say now that Bitcoin is being replaced or has been replaced by the KOSPI. And if you want to go long stocks, I mean, forget the S&P 500. Look at this, dude. Where you been at, man? Why are you playing the S&P 500? You best be playing the KOSPI, man. The S&P 500 is squat here, and you're wasting your time and money if you're doing equities in the United States. Because it went from 2,000 to 8,000 in a span of what, 1 year? Come on, guys. Stop playing with lame, flat things like the S&P 500. So why am I bringing this up? Well, you see, there's a little bit of red up there. That's a little bit, okay, nobody rings the bell at the top, but when the hot money, the degenerate gamblers here, and then you see a little red, that's got to be a little bit careful, if you ask me, when you see, and I see that little red up there. And that doesn't mean it's at the time it could go up, but look, when you see it, you start pumping the brakes. And so I use a KOSPI. It tells me, look, got to pump the brakes a little bit. Watch out. Now, the other thing going on is what's going on with sovereign debt. Now, I've been talking about the iceberg. There's many parts of the iceberg that's under the water that nobody sees. One of them, the big one, is really the sovereign debt problem. I think this is the one that's going to just force a system reset, even if I don't think it's going to happen now. My belief is, and this is many people believe this, and I'm one of these people, is that we're going to have eventually the stock market, if this is that blow off top where it just goes vertical and, it's just like .com, just goes vertical. At some point it pops and we have a crash. Then what's going to happen is the government's going to step in and print because we can't have a crash. And that is in the face of what I'm going to show you, printing to save the stock market and people, because now the stock market is the economy. Because everybody's in the stock market and their general wealth is tied now to the stock market, which is then really just tied to AI. So basically everybody's tied to AI. They got to save it and they print in the face of rising sovereign debt yields. That's what's going to trigger then the final reset, in my belief, right? So it's not the pop of this current bubble, but the reaction to the pop of this current bubble in the face of huge $40 trillion debt that's going to create the final blow up. And that blow up will be in sovereign debt and the treasury market. And when that happens, that's when you're going to have you're not going to have a financial reset just because the stock market blew up. Japan, 1980s, we've had blow-ups up here. Financial resets when the country's debt blows up. And there's no way around it anymore. $40 trillion high interest rate yield, you know, can't print it away because you got hyperinflation versus the black hole of deflation with debt. You know, when you have that, that's when you need the financial reset. There may be wars involved with that. There usually are. And I just think that that's going to happen in my lifetime. I'm not, there's no way to know exactly when, but all I know is it's coming. So the analogy I say is, look, you don't need to know exactly how each crumb of the cookie crumbles, right? There's no way to know. Like, this little tiny crumb falls here, then that other crumb falls there as the cookie crumbles. There's no way to know. Impossible. But that's my point, is you don't need to know all that detail of exactly which crumb and where the cookie crumb crumbles. All you need to know is that the cookie is going to crumble. That's it. You don't need to know all the details underneath. Just know the cookie's going to crumble, and if the cookie's going to crumble in your lifetime, what you going to do? And you got to prepare ahead of time, because you can't wait for it, the crumbling to start, for then to start preparing, because that's when everybody else goes at the same time. And then now you're competing with everybody else to do something, which, yeah. So what you want to do is prepare ahead of time. If you think the cookie's going to crumble, which I think it's going to crumble, and then just start preparing in multiple ways. So when it crumbles, you're already prepared. You're not scrambling like everybody else fighting for the scraps. So we look at the debt of the United States. It's at 5%. This traditionally has been bad news. Whenever we get to 5, the government intervenes. We get 5 here, intervene. Close to 5, intervene. Here's the bad news. All the intervention, we're still at 5. The 30-year treasury is at 5. It's not good. You cannot have high yields on long sovereign debt like 30-year treasury, or the 10-year, which is also high. Now, if you look at this from a technical perspective, it's also not good. This is an ascending triangle. This is not good. That means it's making higher lows. And eventually this is going to go poof, and it's going to go way above it. Right? So it's making higher, 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 higher lows. And then they're trying to stop it here at this 5%. But it just keeps coming back with higher lows. So you know, another higher low. Eventually it's going to move bust above. And when that bust happens, all this potential energy then gets translated, you know, the longer this potential energy has been accumulating, when it translates into kinetic energy in terms of pricing, it's going to be a big move up. And that's going to be very bad news for the United States sovereign debt in terms of treasury. Remember, Hank Paulson came out and said you need to break the glass emergency button in case you could face a failed auction. Nobody wants to buy your debt anymore, right? That's not good. But it's not just the States. Look at what's going on with Japan. Same thing. A ridiculous skyrocketing move in their yields. Their 30-year yield just it was at 0, and now it's at almost 4%. That's an infinite amount of increase from 0 to 4%, guys. This is really bad news for Japan, which I've been talking about and will continue to talk about, because that country, I believe, is going to be in the front runner cause of the collapse when it happens. But it's not even just Japan and the United States. It's the United Kingdom and everywhere else in Europe. Again, same thing. Look, boom, skyrocketed to 5%, again, making higher lows. So I don't know what, look, Germany, same thing. You know, basically ever since COVID, when they did the stupid, crazy money printing. Higher. So everywhere in the developed nation, in the Western economies, the price for their debt is just going up the wazoo, and there's nothing they can do about it. There's nothing the government, they try to intervene, but it's like a drug hit. You know, you need bigger and bigger doses to feel a high. And at some point, you're going to need such a huge dose. You take that hit, you're going to die. You're going to OD. We're playing around with that. Look, I'm showing you. It's everywhere around the Western developed economies. The sovereign debt debacle is coming. Now, if the equity markets pop, and it will pop because nothing goes up in a straight line until eternity, and when that pop happens, they're going to panic, and they're going to, like COVID, print again. Now, if you saw all the charts I just showed with the yields, it's ever since 2020 when they printed like crazy. That was a turning point. And if they do another print, and then it's going to be a crazy print again, similar to COVID because of the crash, that means it's going to skyrocket in. And if the yields skyrocket even higher, like you see like 30-year yields in the like double digits, mamma mia, that's when the debt reset thing is coming closer. So not now, but coming, but watch for what's happening. Keep your eyes peeled. Now, talk a little bit about Japan. It's not cheap, okay? Japan has spent over 200 billion since 2022 to prop the yen up. You know, ever since, if the yen drops below 160 to the dollar, they have to intervene because bad things happen with the yen carry trade unwind and all that other stuff, right? All the bad, ugly stuff. So they've been intervening, and they spent 200 billion. Their most recent one's over 50 billion. But like I've been telling you, so this, you know, their custody holdings are going down because they're spending. But look at, they intervened here, they intervene again, but it's creeping up. Trust me, it's going to creep up again back to 160 because, like I said, it's like the hit, you know, like the drug addict. It just doesn't matter, you know, they're gonna, it's, trust me, even with all this expensive interventions that the Japanese, and they have no choice, right? Look at the Japanese yields going up in the 30 years. They have no choice. So you see how the time is running out. The point of no return is nigh. And once we have again, a crash in the equities that's going to force their hand, that's when bad thing. And then that's also when it's not just financial anymore. It becomes the economics turns into geopolitical issues as well. And this whole thing jives together with a geopolitical, financial, economic reorder, a new order that's going to have to arise. And usually when that happens, you get things such as World War I, World War II, these conflicts as, you know, the jockeying of what is the way that's going to work then if the existing system is going to work. So how is the new system, who gets to control the new, that's where the fighting happens. Like who gets to control what the new system actually looks like around the world. That's when the fighting happens. And that's what we need to be prepared for, because it is highly likely, if you just look at how things are going, we started with the Ukraine war, now we've got this Middle East thing going on, it's not going in the other direction of less and less, it's going in the direction of more and more conflict, different regions of the world, more intertwining with the whole, like, you know, petrodollar unwind, and, you know, there's more intertwining with sanctions and all this with the dollar, and that's happening. So it's going in this direction, not the other way. And I tell you, in 5 years from now, it's going to be even more in this direction. They're going to be even more intertwining with the geopolitics, geopolitical tensions, with the new financial order, with increased sovereign debt that can't be paid back. All of this stuff is going to come up to a boiling point. Right now, what's going on is basically, it's like, you know, playing ball in the park, right? You got two captains picking up their team. They're looking at, hey, you and my team, now you and my team, right? And they're jockeying, right? Iran in the, you know, China, Russia side, and, you know, the Americans, you know, the US is trying to pick up their team. It's having a hard time given what it's doing, but they're forming their teams. And you got like people who haven't figured it out yet. Like, you know, maybe India is still trying to figure out which team they're going to go in. They're doing scrimmages on the court before the actual game starts. That's what's happening. And it's still the pre-game stuff that's going on between the two major teams that's going to eventually start the official game and start to play ball. That play ball is something we've got to prepare for. Now, I do want to move on quickly into oil. And I told you I had a lot to talk about, but look, I'll make it quick. This is the plan that I shared with oil that I've been following. It is a very simple plan. We're in this rising channel. Every time we go on the top, you sell it, go on the bottom, you buy, all right? So once in the beginning, I didn't know what the channel was. We needed some time, but basically ever since here, I was like, okay, now we got this channel going. Whenever we go here, I sell, take profits. When we go down here, I start accumulating and buy. And then whenever it goes up here, again, start selling. Whenever that. So the last time we went all the way down, I started accumulating now. So I have accumulated, and I'm waiting for this to go up here in the channel. It's as simple as that. Now, that looks really simple, but the discipline and the mental fortitude, the 20 rules of training that I have, helps me to do that. Because otherwise you're going to get whiplash by Axios news, and you're going to lose money, even though this has been right as a simple trading plan, but your execution of it falls short, and you may actually not make as much money or lose money. This is what I mean. It's not about the trading strategy. You can have a very simple plan, but what matters is really your execution of whatever the plan is, right? That's more important than the plan. You can have a very simple plan just like this one. Now, with oil, I do want to play this video by Jeff Curry. Used to run the commodities part of Goldman Sachs. Now he runs his own consulting company. But take a listen to what he has to say over here.
And I think it's that the fact of the matter is you have really robust demand. Everything feels good. You're drawing your inventories. But what happens when you run out? And I think that is in some parts of the world it's happening. Europe, it's probably sometime in the next month to month and a half. US, it's probably sometime in July. But they're going to tell you no problem, no problem. Oil is a very small share of global GDP. It has shrank. Now, I want to be careful about the state. I'm going to agree, relative to prices, the price of oil spiking just doesn't matter. But just like the magnets that went into the doors of Detroit cars as a price mat, they don't matter. But when China threatened to take them away, you would shut down Detroit.
Exactly the point. Magnets are, but it is a critical part of the supply chain or manufacturing process of a product. And when you take that choke point and you take it away, the entire thing falls apart. That's the part that people need to understand when it comes to oil. It is a highly inelastic product that is a critical component in multiple supply chains and manufacturing processes. And it's not just oil, as we know. It's nitrogen for ammonia and fertilizer, and the list goes on and on, helium, yada, yada, yada.
Because you don't have those critical minerals. Oil is the same thing. From a price perspective and a share of GDP, it doesn't matter. But you pull it out of the system, it matters. And the reason I bring this up is I like to emphasize the volumes matter. We in commodities, well, how do we quote things? We go millions of barrels per day, or millions of metric tons, millions of bushels per day. We don't quote in notional. Macro people quote in dollars. Financial people quote in dollars. And that is a very important distinction. And I remember, we go back, it was very similar during COVID. I remember we were going, you guys, you have a problem. You got a problem. It's coming your direction. Every commodity guy said, you got a big problem. Every macro guy, every finance guy said, oh, no. Boom, inflation's up 10% year over year.
So he was talking about the avalanche. The macro guys, the financial guys, the generalists, we're just looking at the snow coming down. It's fine. Whereas the commodities guys, who actually, this is what they do, the experts in the materials, was saying, no, you're going to have a problem. So he's saying it's the same thing. So he's saying something similar to what I've been saying. Man, I feel smarter already. You got the guy who ran commodities for Goldman Sachs now saying this. Guys, it's coming, right? It's coming. And let me explain to you really quickly what I mean by it's coming. Look, there are people like the Cycles fan, the generalists, like, they say, look, or just looking at pure technicals, like, look, this is, going to go lower because, look, from the technical point of view, it's highly unlikely the war will resume. I don't know how you know that, but whatever, it's the lower in the coming weeks with occasional bounces. Okay? Now, the CEO of Chevron, he warns of oil shortages. Now, this Chevron, one of the largest oil companies in the planet, CEO comes out and is warning, hey, we're going to have physical oil shortages is on the way. It's coming. Okay? Aramco CEO, the Aramco is the largest oil producer in Saudi Arabia, one of the largest companies in the entire world, comes out and says, hey, market's probably not going to until 2027, amid a 1 billion barrel supply, and he uses the word shock. Okay, this is the CEO of Aramco coming out and saying this is not good, right? He's warning, lose around 100 million barrels each week. It's not good. Then Shell CEO, okay? Shell is what? It was, again, one of the largest global, energy companies. Shell CEO comes out and says it's short nearly $1 billion due to Iran war. The hole deepens every day. It'll take a long time to recover supply. You know, he's warning it will take weeks and months for all fluids to know that. Oh, guess what? The Exxon CEO comes out and says, well, higher oil prices due to markets hasn't seen the full impact yet. Does not reflect the full-scale supply disruption due to the war. Insulated by tanks in China, Brazil. So, okay, that's a CEO of Exxon. How many more CEOs of the actual oil companies, the largest oil companies in the world, energy supply companies in the world, saying this is coming our way? What do they know? They're just CEOs of the largest oil company. I mean, come on, guys, right? Come on. You know what's coming. Now let me tell you what's coming. Now, this is what's happening today. It's not what's coming. This is what's happening like literally today as I speak. Okay, we already got rationing, and Pakistan has got crisis, 4-day work week. I mean, in Sri Lanka, they got QR code. Well, you say, whatever. India is in problem. You know, Modi just came out the other day and it's like, hey, don't sell gold. Don't buy gold. We need the FX, right? They're in trouble, India. The panic is growing for sure. Modi came out and started sounding alarm. The Indian stock market collapsed. In Korea, they already have odd-even driving rules. The clock is ticking. Japan claims they have this much, but who knows? I mean, it's very debatable. UK price shock, German tax relief, France aid landed, levy extended, tax cut, subsidy, the SPR drought. We'll talk about this. I mean, this is happening already, but this is still not in Korea, right? Gas station closures in Korea. It's already now. Wall Street, on the meantime, they have a core assumption, as I shared. The cabal and the Wall Street, their assumption is that on June 1, everything's back to normal. Not only back to normal, what they're saying is by June 1, there will be a new multilateral system set up for the Strait of Hormuz that is ratified by the UN Security Council. And that is their basically worst case scenario. And that's 2.5 weeks. Guys, in 2.5 weeks, and now even less, I really don't think that not only will we have Iran have a multinational, multilateral agreement like the Straits of Gibraltar type of setup for the Straits of Hormuz, that is also then ratified by the UN Security General Council in about 2 weeks from now? Really? Like, I really don't think so. Not based on what's been going on. You might think that in 2 weeks we'll get all that nip tucked and bud and voted in the UN Council. Forget about any agreements being signed between the United States and Iran. But I don't think so. I think that's quite a reach. I really don't know if in 2 weeks we're going to achieve that based on how long this has been going on already. And so I'm a little bit worried about this. I don't think Wall Street has, again, priced this all right. I don't think so. Trump has come out and said he's going to suspend the federal tax on gas. Now, this gets all complicated where that money goes and into the highways fund and all that. But just to put it really quick, he wants to keep the gas price low. Now, what that does is it artificially suppresses prices, which means demand is artificially propped up, because if prices goes up, demand should go down and things get more expensive. But they're trying to synthetically manage prices so it's low, so that demand does not organically adjust to the reality and is artificially propped up. And that's what you're doing. What that means is later on, when the price is not artificially managed and it goes up, then demand will collapse and you'll have a big moment. Right? So the hope here is that everything gets back to normal by the time they don't manage things artificially anymore. And so that is the big hope and what we're all praying for, because if that doesn't happen, this gap will then collapse together and you'll have big movements that are generally very bad. Now, if you look at what's going on in the United States, they're not really producing that much more oil. Oil production has been pretty much flat. Okay, since the past few years, meaning we're kind of tapped out in how much oil we can, so you got to drill to get more, but we haven't been producing that much more oil, or should I say the United States really hasn't been creating or pumping more oil out of the ground. But what's been going on is that it's been extracting oil from its reserves. Now, the last time it extracted oil was during the Biden times. And why did Biden extract? Because, well, oil was getting expensive. And this one was as a result of the Ukraine war, and inflation was going high, and Biden wanted to get reelected. So he released from the SPR reserves oil, which then made oil price go down. That was not really a good move because there was no, okay, but whatever. And this is what's happening again. More reserves are being released because now we have the Middle East problem. So production of oil is pretty flat, but we're releasing oil from the reserves. So that means that even though production is flat, the supply of oil is going up based on this. Now you see, if this goes down, you're going to, how much more reserves do you have? Remember, you need a certain minimum amount of reserves, otherwise the caverns are going to collapse. So we're getting close to where you can't even release anymore. There's a bottom line here. Now, supply has been increasing from the reserves, and where has it been going? It's going into exports. The U.S. has been exporting oil out. All the ships are coming to the U.S. to load up, and the U.S. is export. But the U.S. is not producing more oil. So where's all the oil coming for the export? It's coming out of the reserve. So basically, the United States is taking oil out of its reserves and then exporting it out to the rest of the world. So from reserves to the world. That's basically what's going on. You can see big ships coming in empty to the United States. Why? To load up from the oil. Where'd the oil come from? From the reserves. Why? U.S. is actually not producing that much more oil. So tell me how this is good for the U.S. Now, as a result of that, the spread between futures and spot oil has collapsed. Remember, it was really high. Now it's collapsed. But here's the danger. As I've been saying, this has been, so just like the gasoline tax, what's been going on is the U.S. has been pumping out oil into the global markets using its reserves, which has a finite limit. It's not forever they could do this, and the limit is coming close very soon. And taking the reserves and putting it out into the global market to manage oil prices down, that has caused spot prices to also go down, along with futures prices, on the hope that everything's going to get resolved. Now you can see this is an artificially managed thing. It has, as a result, not resulted in high enough oil prices to start demand destruction. So demand is still high. And so we have this low oil price and high demand, this artificial setup that if this doesn't resolve magically in 2.5 weeks or soon, is going to collapse together and cause all sorts of problems. All sorts of problems because it's been propped up. And the propping up can't continue forever because there's a limit of the reserves that the U.S. can tap into and send out basically to the rest of the world. It is not an unlimited supply. And that is why I'm very worried about this setup and why I still play long oil at this. Now, you know, if we look at this, demand destruction regime requires oil to be at this 150. We nowhere went 150. Right? So that's what I'm saying. Demand destruction has not happened. This is a dangerous setup. People are going around the world thinking everything's okay, hunky-dory, and continue, not changing my lifestyle. Everything is not a problem for me. Meanwhile, the supply is there for now, but it's been propped up artificially, and that artificial propping up has a limit, which is about to end soon. And you see what I mean? When reality hits, mamma mia. Mamma mia. Now, it's not just oil. I just want to show you, potatoes had this crazy spike from $2 to $18. Now, okay, this was a futures contract rollover driven thing, but it doesn't matter. What I'm saying is, look, 70% of the agricultural farmers in the United States, they cannot buy all plant because of the cost of fertilizer. That means the next crop season, you are going to see food inflation come back with a vengeance. You see that CPI report last week? It was a little hot. Dude, that's nothing, man. Oh, I'm going to talk about CPI this weekend, but man, bad things are coming with inflation. Now, I just want to end with what's going on with silver. Silver, as I've been saying, I'm watching, right? This, if we go above this, I'm saying that that's a buy trigger for me. And I have been buying cautiously silver because this looks like a higher low. And if we break above and make a higher high, that's a bullish thing. And guess what? We did break above it. Now, I was playing, but I'm still very worried because I said, like, if we break above this, then this obviously is the next target. Everybody and their grandmother knows this, about 95, 96. So will we get there? Well, perhaps. I'm playing long, but very cautiously going in and out. Because, what happened was the other day we had a hangman, and then now we don't have this follow through. So I'm very careful. This could be a potential fake out before we go down. I don't want to get caught in that fake out. So I'm not putting in no like big positions and, just ride it until it goes up to here, but rather small positions, trying to see if I can ride this up. Not sold yet. Now, if we go above here, 96, and we go above, that's a different story. I'll be long silver then. All right, so this episode is quite long for a midweek banger. I hope you enjoyed it. But yeah, that's all I have for today. Let's see what happens. Again, this is President Trump is in China with like all the freaking CEOs of all the companies trying to make deals with Xi and the Chinese. Let's see how it goes. Iran is going to be part of the talk over there, and the foreign minister of Iran, Arashi, was in China earlier, and they probably talked about what Xi's gonna say with Trump about Iran now that he is there. So let's see how things unfold. Thanks for watching. I'll see you in the next episode. Peace out.